Hello everyone, this is Ryan Devin with the Devin Team at Keller Williams coming to you with another episode of what you need to know this week in Denver real estate. So this is the update for November 2022. We've got a lot to go over today. So big news out of the rate markets. We saw consumer price index drop by 0.6, which actually brought our interest rates this month down below that 7%. And making it the largest interest rate drop in a day since 1981 when that happened. So I would anticipate that we see movement in rates for a while, some ups, some downs, but things are looking pretty good in terms of the improvement. Even bigger news as well, the new conforming loan limits have increased this week up to $767,000. So what does that mean for you? It means that you can now purchase at a higher price home without having to go through the hoops on a jumbo loan. That means less down payment for a higher home. This adjustment also says something else to me, and it says there's a bit of more confidence in the housing market amidst the changes in interest rates and inflation. So these amounts are increased due to appreciation in the market. So if we were in a depreciating marketplace, I would feel that this probably wouldn't have increased and it would have just held at the previous level of $687,000. So really good news. Our market did respond to all of this with more homes going under contract, and we did have an increase in mortgage applications. Our inventory has also dropped a bit from the last update. So we are down to 2 months worth of inventory on the market now. Again, meaning that if no new homes hit the market, all the inventory would be sold within 2 months. Having 2 months worth of homes still means that we only have about 33% of the required inventory to offset the demand. We're still way out of balance, remember that. A few other market stats to update you on. Our average days on market has fallen down to 24 from 27 on the last update, and we're seeing an average of about 1.6 showings per home per week. So hey, wanting to wait for those foreclosures and distressed sales? Well, out of the 3,500 homes that closed last month, there was only one distressed sale, and it wasn't even a short sale. It was a short sale, not a foreclosure. It was a condo. So we don't anticipate a flood of these hitting the market. With the amount of equity that our market has gained over the past few years, if someone is in distress, they'll most likely just sell and make a profit still. So I wouldn't sit around waiting for that to happen. One of the things I did want to address is that if you are following the news stories and the headlines, they read how much value people have lost in their homes. Let's take a second and unpack that though. So we've gained over about 40% in equity since the pandemic. So if home values have gone down by 7% from the peak, you're still up 33%. So now for those who have purchased in the past year and maybe had to overpay a little bit, you're feeling that a little bit more. However, realize we don't day trade homes. They're long-term investments, and as long as you continue to stay in your home, you're going to realize the gain in that appreciation. It just feels more dramatic right now. Again, it's a long-term gain. You will gain your equity actually faster due to the lack of inventory in our market than in previous markets, so you'll bounce back a lot quicker. Something to consider is that with that long-term approach. So whether you bought at the top or the bottom, real estate always wins. I mean, you've never met someone who's living in their home and say, man, I wish I would have never bought this thing 20 years ago. That's not, it's a long-term gain. So looking forward, I'm actively watching what is happening in the markets right now, as our real estate market is very much tied to what's happening with inflation. So as I've mentioned before, the Fed is trying to slow down spending and get the economy under control. Jobless claims went up just a bit, as the Fed does. They want to see unemployment at about 4.4%. So once consumers start spending less, then things will be a bit more where the Fed wants to see it. Although last month consumer spending debt did increase by $25 billion. So we're not at probably what the Fed wants to see as of yet. Most reports, however, are indicating that we should see a more sustained drop in interest rates really in that second quarter of 2023. So we shall see. Whew. I know that's a lot of information, and I thought that we went over here today, but for me it's really important and it's relevant that you understand and consider what's going into the largest asset that you own. As always, I appreciate your time. I appreciate all of you. If you know of anyone who could benefit from this information or a conversation about real estate in general, how it impacts them, what they should be looking forward to, or just to ask some questions, I would love an introduction. Thank you all so very much. Have a blessed day. Again, my name is Ryan Devin with the Devin Team. Take care. Bye-bye.